Hi everyone, my name is Misiewicz. I'm just going to share my screen. I'm just doing a quick check before I start tonight's session. In fact, I've got to put my lights on. That'll be helpful. I'm going to be starting. Hello, good morning. And I'm echoing. Why am I doing that? Let me just get rid of that echo right there. I'm going to be starting tonight's session in just a few moments. So I'll be closing off the video for just about a minute. I'm going to be just making sure the lights all work. And I'll be starting this session, like I say, just in a few moments. So make sure you've got your pens and paper at the ready. I'm going to be doing this in 3 sections as normal. And the first section is in the news. So we'll have a look around the tabloids, what they talk about property investing and about property tax. And then next stage, I'll be looking at what our clients have said, so the client FAQ. Going through that just to see what our clients have been asking last week and to see if that reflects your questions. And then next session will be taking an open Q&A. So hopefully some of the things I'll be sharing with you tonight will then give you room for Q&A, and I'll be then going through those lists of questions that you may have. We have people on our webinar, which we'll be removing soon. We're going totally YouTube live in the next week or so. So it'll be easy for me to manage those questions. So I shall be with you in just a second. I'm just going to make sure my lights all work, and then we'll be up and running. See you in a second. Okay then, guys, good evening to you all. I'm finally on, just trying to not kill myself with cables. The cables is right behind me, and now I've just disconnected the cable. So this is really not the most professional start, I have to say. But good evening to you all. Hopefully you're well. Please drop a comment, say hi. That make sure that I know that I'm actually live with you guys. So hello. Make sure that you say hello. Sorry, just a typo. Hi, everyone. If you could type in hi, that makes sure that I know that things are working. So please do that as soon as you can, and then I can at least make a start on the Q&A. I'm going to be breaking this session down. You'll notice I'll be pairing over. There's a little line at the bottom on my screen. That's purposely there. That's my laptop. Last week, I stood up like an idiot, to be honest, and I tried to do this kind of standing up. And it wasn't really that relaxing. I had to look over my screen to do a Q&A, and it just didn't work. So this time around, I've got some Q&A, and I've done the Word document in large fonts. So as I say, I'm going to do this in 3 sessions. The first session is in the news, some real interesting insights to the tabloids this week in terms of property investing and indeed property tax. So I'm going to go into that. Second stage, I'm going to do client FAQ. So this is whereby we're going to look at what the other clients have been saying, or our clients have been saying, or asking questions of us, and then I'll be proposing some of those solutions that we put them their way. And then finally, we're going to be going into the open Q&A forum. So if you do have any questions, then you can feel free to ask away, and we'll get through those. So good evening to you all anyway. Let's talk about what's in the news. I've got some documents here that I've been using just to help me out. Some of the insights I've been seeing from This Is Money, I've been talking about capital gains tax changes. There are some imminent changes to capital gains tax from April 2020, so not too far away now, really 11 months away, where they're changing the way that landlords are going to be taxed on their properties for capital gains tax from April 2020, as mentioned. And it's really focusing on private residency relief, which is PRR. They're also going to be making some changes to lettings relief as well. So we need to think about, well, what kind of change that's going to have. The first change is private residency relief. Currently, if you leave a property, so you leave it vacated, you have an additional 18 months in which you will get capital gains tax allowance. So basically, you don't get taxed on that element even 18 months after. You only then get taxed on the 19th month and beyond, and it's apportioned. The big change is the fact that the 18-month period is going to be reduced to 9 months from April 2020. So that's one change. The second change is lettings relief. Currently, if you have a property that you move out of as the main home and then you get a tenant in, you can get this lettings relief, which is the lesser of typically 3 numbers, which is the £40,000 lettings relief minimum, the gain itself, and something else I can't remember now. It's gone out of my head now. I'm trying to talk to you, but ultimately that lettings relief is going to be removed altogether, which is not a good thing. The only time you can keep lettings relief is if you lived in the property at the same time as a tenant. Well, that's completely changed the ballpark, really. And my argument would be, well, if you had a tenant in there and then you had a lodger, then you sold the property, well, you're going to get private residency relief anyway. So the lettings relief is kind of a moot point and a bit of a waste of time. So This Is Money produced this article and talked about HMRC generating an extra £470 million because of this change. And that's a real big hammer blow to anyone, because that is a significant change. And it's going to obviously mean that as property investors will end up paying more tax than ever before. So not a good way at all. The other side to it is, I'm just checking one other piece of material that was relevant to that, actually. Let me just have a look at those details. So yeah, so the lettings relief was a bit of the scupper by this whole thing. Accompanying tax changes, I also looked at what the papers were saying in terms of property investing per se. One of the articles I read was all about this Section 21 eviction notices. Clearly, there are 2 ways of removing tenants. There's Section 8, and then there's the Section 21, and the Section 21, as we currently know it, is going to be abolished. So we won't be able to get down to that process. There is going to be a change, I believe, on the Section 8 as well. So we're all going to be ramroded down to one way of evicting tenants, and it's got to be, in the government's eyes, a fair treatment of tenants, which means that it's not really going to be fair for landlords. So I'm not sure what's going to happen with that. Yeah, time will tell whether that Section 8 will be amended for the benefit of us landlords. Another change that came in, interesting enough, was the CIOT, which stands for Chartered Institute of Taxation, which our company is a member of. And one of the things that they've been asking is for the government is to stop tinkering with the tax changes for property investors and landlords. Clearly, there's been a lot of changes with the removal of the 10% wear and tear allowance if you had furnished properties. Then there's the 3% SDLT surcharge. Now you've got the Section 24 being phased in at the minute. Then you had this international. So if you didn't live in this country, capital gains tax was going to be around that. They made another change for capital gains tax payments. So from April 2020, you'll have to make those payments of tax within 30 days. And now, the CIT have said, look, enough's enough. You've had an attack at the landlords. These guys need time for adjustment. They need to sell their property, so give them some time. And I would echo that point. I think the fact that the government, has one attack and then has another attack is pretty disproportionate in terms of everyone else. What are you guys finding? Are you finding that the number of changes is quite overwhelming? Please drop a comments box in here just to say hi, by the way. What changes have you seen? How are they affecting you? Please drop your comments in. And indeed, if you've got any questions, then feel free to type those in. And I'll be sure to answer those as we go along tonight's session. This is Money. It's interesting. This is Money is always producing pretty decent articles of late, especially. And they talked about, it's worth going on to This is Money because they written an article about a lady called Emily Evans. She's the age of 30. She's built up a property portfolio of 1.5 million. So a good sized portfolio. And in that same article, they talked about the, in terms of the yields that you can get from the UK. So it talks about Emily, but then had this little map about the yields. And I thought it was really interesting because the cited Westminster had a yield of 6.6% yield, which is probably the highest one that they were citing in their article, followed by my hometown, Nottingham at 6.1%, and then Manchester at 5.6%. And I thought, well, that's an interesting, you know, it was more of a positive slant, which is very welcoming. I'm not sure about you guys, but I am seeing an awful lot of negativity about property investing and being a landlord. It's just a nice, pleasant article to read about something positive. And you know, Emily Evans at the age of 30, building up a property portfolio, 1.5 million, is continuing to invest in new property. So just goes to show you that it's not all doom and gloom. And thank you, This is Money, for building a positive outlook for this. A couple of things that Emily mentioned was beware of auctions, and it's something that I'm very aware of as well. People going to property auctions, especially in London, will have this kind of syndrome of putting their hands up all the time to increase their bid for that property. And I have noticed it personally. I've attended a few auctions whereby the property price has now exceeded in the auction room the open market value of a property just down the road, of a similar property on Rightmove, for instance. So you do need to be very, very careful of auctions. And I'm pleased that someone like Emily has said, you know, as a tip, do be careful with those. As you mentioned about having a power team, I always talk about power teams. My power team typically will consist of a good tax accountant or a tax advisor. Then I would have a solicitor and a mortgage broker. And as long as you've got those three in your team, then you should be okay. Emily went beyond that. She talks about tradespeople, in effect, whereby you should get yourself a good power team, so electrician, plumber, builder, etc., because it's those that are going to do your refurbishment and development. And if they're not reliable, then it can cost you a significant amount of money. And I would stand by that too, because we have two tradespeople that we constantly use, and we don't use anyone else. And it's because we've got a good relationship with them. We know they're not going to bunk off their jobs at 2 o'clock in the Friday afternoon. And equally, they're not going to bunk off to another job that they've promised the customer, leaving us in the lurch. So I agree with Emily in this regard. And it's worth, like I say, go to This is Money website and have a look for Emily Evans. Maybe do a Google search on Emily. But really good. And funnily enough, everyone talks about Rightmove and Zoopla. The other search engine that Emily cited was On the Market, onthemarket.co.uk, where you can find property prices. You can do all the things you can do on Rightmove and Zoopla. But she mentioned this website as well. I personally haven't looked at On the Market myself. It's not something I've really used, but it's worth maybe you have a look at that and see if it's any good for you. A big piece of literature that I read was about Foxton's Group that announced the departure of their chief financial officer, Mark Berry. And the reason for that departure is all because of the estate agents' sales were the record low. They didn't mention necessarily the tax changes as such, but they did mention Brexit. I was personally trying to sell a property, And I know a few of our clients are trying to sell properties and they're not able to do so because of Brexit, which is really, really interesting. The fact that the government wants landlords to sell their properties, and they tax them at the highest levels of CGT, no less, which I think is an awful way of doing things. You know, they're asking people to leave, but they don't have a negotiation skill. They just say, well, we're going to hit you with a hammer if you do what we ask you to do, which I just think this government is typically bonkers, right? But now we've got Brexit as well, so landlords can't actually sell their properties. So they're going to be feel like they're cornered because the government can't get off the backsides and sort Brexit out. Which between, you know, are you frustrated with Brexit? Do you find that the government is pretty weak? I remember, I'm not going to go to a Brexit debate, but it's interesting. I went over to Naples in Florida, America, and we were pretty much a laughing stock across there whenever I was speaking to business people over there and just saying, you know, you guys just need to sort yourselves out. And it echoes what had been said in Europe and Australia, and just our government being pretty weak. And I echo that. I just think it's crazy. But I won't go to a Brexit debate. That I'll leave that to other people that are more knowledgeable on that subject than I am. So moving, you know, but you know, are you trying to sell a property? Are you finding that selling a property is pretty difficult right now? If you do, then feel free to type that in as well into your in the comments box. Please do feel free to write in the comments box. I'm not seeing anyone type in anything at the minute, so please do so, just so I know that you're there, and I can then answer any questions that you have. So even if it's say hi, please say hi. So something else that came through was Spears cited that there could be a knock-on effect from overseas investments. And this is directly linked to the subject matter of HMRC changing the capital gains tax for overseas property investors. If you're an overseas property investor now, you will be hit with a capital gains tax liability. In the past, that wasn't the case. Now it is. So if you're overseas and you invest in residential property investments, then you will be subject to capital gains tax. Never before has that happened. And Spears, interestingly enough, suggested that, well, if they aren't going to stop with all these tax changes for property, could HMRC change their view of commercial property as well to stop foreign investors buying commercial property? And they felt that if they were to go down that road, there would be a knock-on effect on the economy as a whole. And I thought that was a real interesting insight in terms of the, you know, we're all looking at residential property investing because that's what the government have said, but it wouldn't be the first time that the government has said something with a hidden agenda, would it? Let's be fair. So are they just trying to raise as much tax and just hiding behind some of these spins that they put on things? And therefore, could they go after international investors that own commercial properties and therefore generate more tax, but could have a knock-on effect on the overall property investing for commercial property, not just residential? What's your thoughts on that? Are you finding that there is a particular issue in regards to residential landlords being attacked, but do you think it's likely that commercial property may be next on the agenda from HMRC? I'll be interested in your views and comments, so feel free to type those in and I'll have a look at those later on. A couple of things, I'm just going to take a drink just very quickly. So a couple of things that have come through is converting residential to holiday lets and capital allowances of VAT. Let me just say that again shortly. So we have a couple of clients. These are client calls, and now this is session 2 we're into already. And what was being mooted, I'm just going to check my webinars questions because it's just going through there, so that's fine. I'm just double checking on something. So the clients have been asking the question along the lines of, I've got a residential property, can I convert it to holiday lets? And why might people do that? Well, if you have a home and you wish to vacate that property, you've bought your own home, which you have to be careful of, because if you do vacate your home and you don't sell it, and you vacate, then you will have to pay this 3% SDLT surcharge. So I'm always saying to clients, are you sure that you want to leave your property, buy a new property, but leave the current one as a buy to let? Because you're going to have to pay this 3% surcharge on a new property, which will kill off any profits that you're likely to make on a buy to let anyway, in my view. But that by the by, so they're happy to pay the 3%, but the current property that they're living in, what they're saying is, well, can we convert it to a holiday let? And yes, you can, as long as you comply with the HMRC requirements. Holiday lets typically need to be available to let for 200 days, and it needs to be physically let for over 100 days. And therefore, as long as you comply, yes, you can get some sort of tax release. First of all, being capital allowances. Capital allowances is a tax incentive, really, to look at all the furniture in the property, look at the fixtures and fittings, equally things that are integral to the property. So the kitchen, the bathroom suites, the plumbing, the lighting can all be classified as holiday lets. And there's an organization called Six Forward, just out of interest. I'm just going to make that as a note so I can, later on, what I will do, I'll write up my notes in the blurb in the description, just to let people know what we've been talking about today. But Six Forward is a company that will do a report for you, and that part of that report will be for them to say, yes, we believe that capital allowances are allowed. This is a property value at 200,000. We can identify that there's, let's say, £40,000 worth of capital allowances, and if you claim that in the first year, there's something called annual investment allowance. And again, I'll just put that in there just as a reminder. Annual investment allowance means you can claim that £40,000 in the year that the property is acquired, and that 40,000 would be offset against your property, your holiday let profits. So that's a good incentive to have a holiday let. You've got the capital allowances, which you can claim to reduce your profits of your holiday let, and that's really, really good. The downside to holiday lets is VAT. Once your income from your guests, and your guests may come from Booking.com, or it might come from what's the other one? Airbnb, the bigger one. Airbnb. Why did I forget that? But Airbnb, Booking.com, you might list your product on there. Once your turnover goes to £85,000, you may have to be VAT registered. So that's a downside to all of this. You are not going to get away from that. There are some things that you can do around VAT, like flat rate schemes and so on. But typically, VAT on will be required for you to charge your guests once your turnover is £85,000 or more. And that really does affect those people that have more than, let's say, 2, 3, 4 guest houses or holiday lets in their portfolio. That is when £85,000 worth of turnover will be breached, and that's in the last 12 calendar months, by the way. So you add up the last 12 calendar months. Once you've reached £85,000, then you will need to be VAT registered. That's an interesting one. Another client asked a question about they've got a limited company and they want to transfer assets between their loved ones, whether it's minors or their spouse. And there's a couple of things that you need to think about here. Is the first one is capital gains tax. If you are seen to be selling your shares or gifting your shares to a family member, then you could be subject to capital gains tax. So you need to work out, well, what is the net assets of my company? And the way you would do that is to look at your property values less your liabilities, and that will give you net assets. And let's say that you had £100,000 and you happen to have £100,000 worth of shares. You've got a pound value now for each share. Well, if you want to give 30,000 shares over to your child, you potentially could have a CGT bill because you've got a £30,000 which you're gifting to your son or daughter, and as a result of that, your capital gains tax allowance may not be sufficient enough to deal with that transaction and therefore pay CGT. So you do need to be a bit aware of that. There's the other side to it as well. You pay stamp duty on the £30,000 of 0.5%. So there are two costs that you need to consider. And a lot of our clients would typically say, well, I can just do a transfer and that should be okay, without really thinking about, well, what tax implications are there? And equally, some of the things that we're seeing is that, I'm just going to put this on here as well when I do my notes. When father, mother transfer shares to their siblings, and it goes over 1% of the total company that the child now owns, there is an issue with mortgages, because the lenders do not want your siblings to be on as a company shareholder at all, really. The reason for that is because, for their purpose, is risk. If your ownership is now being diluted, that means surely that your liability to that mortgage is now just a smaller percentage than it was before. And therefore, what they're suggesting is that your charge should be on the mortgage application, which isn't going to happen, is it? Let's be fair about it. So we do need to bear in mind what you are doing with your shares. I would take professional advice each time when you're doing things, and then that way you can say, well, what can we do to transfer shares between myself and my children? A couple of things. Why would people transfer shares? Maybe have a think about that and put your questions down. If you are thinking about transferring shares, put that in the question box, and I will come back to your questions later on. But a couple of reasons why people might do transfer of shares. First of all, someone might do a transfer of shares because they want to gift some of their shares as a way of a thank you for getting involved in the business. The child might legitimately be involved in that business, making decision making with a group of people, and as a result of that, they want to have that ownership to be accountable, I guess. The other side to it could be IHT. So father, mother wants to reduce IHT. Property investments in the company, bear in mind, will not benefit from what we will call the business asset rollover, whereby you can transfer assets of a business and trade to loved ones and not be subject to IHT. Property investments inside of a limited company will be subject to IHT. So that's a major, major downfall in terms of having properties in your own name, or indeed inside a limited company, will be subject to IHT. And from the basic level, you are allowed £325,000 worth of IHT allowance per person. So if you're a couple, you get £650,000. But imagine if you had a property portfolio inside a company for £1 million. All of a sudden, you've got a whacking tax charge in the excess of that 650. So a lot of money to pay out. And that's why people try and do a transfer of shares before they die to mitigate the IHT liability. So that's a big, big thing for people to do it. But they could be screwing themselves over with the CGT and are subject to IHT as well. So you do need to take some proper advice on that. I have seen people make some mistakes in that one, unfortunately. What other questions we've got? So adding shareholders. So similar, if you are adding shareholders, you do need to make sure that you're completing the right documents. It is a legal requirement, so make sure that all paperwork is completed properly and sent into Companies House as well. So I'm going to just mention company forms on the description below. So if you want to come back to it, you can have a look at those later on. What are the questions we're coming up? CGT selling property. So there is a lot of clients now looking to sell their property portfolio. The issue with capital gains tax from a HMRC perspective is that they reduced the capital gains tax for basic rate taxpayers from 18% to 10%, and for high rate taxpayers from 28% to 20%. Unfortunately, they didn't do that for residential property investors. So if you're holding residential properties and want to sell as a high rate taxpayer, you are still going to be hit with a 28% tax liability. Which, if you're selling a portfolio, that's significant, because what you're not doing is making the best use of your annual CGT allowance. So what we always say to our clients is, well, listen, phase over your disposals for a number of years. and that way you can mitigate your capital gains tax liability, or at least reduce it by your annual allowances. We also talked to them about, I'm just going to put this on here as well for later on references. You can use things like deed of trust, which is a document which says transfers between husband and wife is free from capital gains tax. The reason why you might do that is if you've got a property in your own name and you dispose of that property, you'll have just one annual CGT allowance. If, however, you had your husband and wife on the deeds, then all of a sudden you get 2 CGT annual allowances, which hopefully will reduce your capital gains tax, especially if you're phasing your disposals over a number of years. So a deed of trust is something that is easily done. We can do those for about £295. We're not doing as many of those. We do suggest that solicitor is your best vehicle, to be fair. But a deed of trust is a tax enablement, tax reducing enablement for you. The other side to it, in terms of reducing CGT, if you want to dispose of your properties, is to use things like EIS, which again I'm going to put in there, VCTs and SEIS. These are alternative investments. Now, I'm not a wealth manager. I am not an IFA, independent financial advisor. Therefore, I would suggest that you do speak to an IFA wealth manager to understand what these types of investments are. So the types of investments I've just mentioned, by the way, is EIS, enterprise investment schemes, VCTs, being venture capital trusts, and SEIS, which is seed enterprise investment schemes. If you invest the gain of your property, let's say, ignoring annual allowances here, but if you had a gain after annual allowances of £100,000, if you're a high rate taxpayer, you could be hit with a capital gains tax bill of £28,000, 28%, right? But if you invested that £100,000 into a VCT, EIS VCT, then you would not be subject to any capital gains tax liabilities at all. So you can mitigate CGT, and if you do it correctly, you can phase those disposals of EIS, SEIS, and VCTs over a period of time to have no capital gains tax ever again. So it's a great way of doing that. And the nice kicker in terms of EIS, VCTs, it could be free from IHT as well. So a double whammy really of benefits. But I would say make sure you speak to your IFA and your wealth manager. Don't ask me questions about those things. I'm not regulated, and therefore I can't really give you advice. This is something else that keeps coming up now with Section 24. People are fearful of all of these mortgage interest relief cap, meaning that people can be taxed. If you're a high rate taxpayer, you know that you're paying 40% tax on your property profits in the tax year 16-17. You would have seen that creep up maybe to 50%. By the time you get to year 2021, the whole Section 24 is fully in place, which means that you do not get 100% tax allowance on the mortgage interest, but you do get 20% tax reduce of the mortgage interest, which means if you're a high rate taxpayer, you're only benefiting from 50% of the mortgage interest as a allowable cost. We've done an awful lot of calculations. So every tax year we would do client self-assessments, and we do a forecast in terms of the impact of Section 24, and we write them a very quick report to say this is your impact and these are the things that you should think about doing. Book a call with us. One particular client went from being a 40% taxpayer to 145%. Yes, that's right, 145%, which is crazy, absolutely crazy, which basically meant was all of the profits went to HMRC, plus an extra 45% had to be divvied out of their own personal bank account to pay HMRC their tax liabilities. So what people are trying to do is now incorporate their property portfolio via a partnership, and the way we're prescribing that is that you need 2 or more people within a partnership. Typically it is going to be a husband and wife, and as long as they comply with the Partnership Act 1890, where they are deemed to be in business to make a profit, and they work in business, so they're not outsourcing the the work to a letting agent. They are doing things themselves. And incidentally, the Ramsey case a few years back, the court agreed with the Ramseys that capital gains tax should not be charged on the incorporation of their property portfolio from their partnership in their own names into a limited company. So ultimately, you can incorporate into a limited company free from GST and stamp duty, land tax, subject to you complying with the Partnership Act 1890, which basically means is you are in business, you're not a passive investor and giving all the responsibilities to your letting agents. We've got I think a 50-point checklist now on partnerships and making sure that you're doing this correctly. It's not easy. The reason for that is because you need a partnership agreement in place. You need to submit 3 years worth of partnership returns to HMRC. It cannot be seen from the outset to be a contrived activity whereby you move into a partnership only to incorporate, because that's going to be an anti-avoidance case. So you do need to be very, very careful in terms of your planning. You need to be showing that it's a partnership and that's where you want to be. And oh, by chance, we're going to be incorporating. Well, you might want to wait until the third, fourth year to do that. So demonstrate to HMRC that it's not contrived, because they will charge you an SDLT liability. So you do take some professional advice on incorporation. There's a lot of things out there which people suggest using a beneficiary income company trust. I'm not a fan of that because of GAR. GAR is a general anti-abuse rules of using limited companies to get a tax advantage. And I think that using a beneficiary income company trust, which is BICT, is really firing in the face of GAR. And time will tell whether HMRC really attack those schemes. But for me, it's no different to the schemes that you see in terms of using those loans outside the country and then money back to yourself and don't pay tax on it. Oh, they worked well, didn't they? So beware of those kind of things. There are a lot of people singing about these things, charging £20,000 to do it. But ultimately, you are responsible for your tax, not the barrister that's sailing you down the river. A couple of a big question is coming up from our clients saying, well, are you thinking about Section 24? How is it affecting you? Type that into a question box. Are you looking at ways around Section 24? And if so, type that into the comments box. If there's any questions I can answer around those mitigation factors, I will. Are you thinking about using limited companies and partnerships, and how far down are you in terms of that line? Feel free to drop your comments box as well on that, and I will get to you with any questions that you may have, and I will try and supply you with some answers. But one of the final things I saw from our clients last week was investing in my own name or a company structure. And because of Section 24, I would say that from the face of it, if you're going to be investing in property, you should use a limited company. There are some caveats towards this. And interestingly enough, I'm going to put that in there, give up job. If you're a high rate taxpayer, then it would make sense to use a limited company because the tax rate on a company is 17%. Even as a basic rate taxpayer, you're going to be paying 20%. And because of Section 24, you may end up paying more than 45% in tax anyway. So in the face of it, it makes sense. But you do need to take into account the interest charge from banks, because in a limited company, we're seeing that rates are typically 1.25% to 2% higher in a limited company based on your experience, based on the property portfolio you already have. And that interest charge, additional interest charge in a company, may well be more than the tax savings that you're making by using a company structure in the first place. So you do need to think about that carefully. And again, this is where I would always say, speak to your triangle of professional advisors, your accountant stroke tax advisor, your solicitor, and your mortgage broker, so that they can give you their perspective of what the Section 24 using companies is likely to be for you. And then you can make your own informed decision. Don't use things like Facebook, LinkedIn to get your answers. It's just not going to work. Those forums are great in terms of giving you ideas, but it shouldn't be the one that you base your conclusions on. So typically the one thing I would say, yes, it sounds like you should use a limited company if you're hiring a expert, but we have to be mindful that we have a number of clients that have invested in a limited company, and they've done really, really well to a point that said, do you know what, I'm going to go do this full time. I'm going to give up my job. And this is happening maybe just 2 years down the line when they're starting to use a company. And I'm scratching my head because I'm thinking, this is a disaster, because albeit in those 2 years you've made a tax saving, what we've now faced with is the fact that you're paying 1.25%, 2% more in a limited company than you could have done in your own name by buying properties, and just accepting that you're going to be paying high amounts of tax in the first 2 years. Fine, but you're giving up your job, so Section 24 may not be a burden on you at all. But now you're faced with this, you've got properties in your company, you might start then buying properties in your own name, and you've got this mixed bag of property portfolios going on. But the big thing for me is that you've now, you haven't really planned ahead. We ask our clients, are you thinking about keeping your job for 5 to 10 years? And if you say yes, then the limited company is good. If you're thinking no, and one of you, whether that's the husband, wife, or civil partner, one of those partners saying, well, actually, I'm thinking about giving up my job, then it may be better to use a deed of trust to reallocate the property income from one spouse to another, and to keep the properties in personal names and accept that Section 24 may be a factor for you. So things for you to consider before you jump into using limited companies. I think they are good vehicles, but they're not the one and only vehicle. I think you should take an informed decision and to make a better decision for yourself. I'm just going to now go into the next question. Let me just have a look at those. So I'm just having a look at any questions that have come in. So no questions come in so far, so that's interesting. That's the first time that's happened on my webinar side of things. I do have a question here. I'm just going to try and zoom this up because my poor eyesight does not work. So Philip's asked a question, could you explain as a flipping company how you could avoid the 3% SDRT surcharge when buying probate properties direct from executors? Is there a maximum amount you can spend on them? Now, here's an interesting thing, because if you're mentioning a property developer and you are buying from an estate, then you don't have to pay SDLT at all. That's right. If you are a property developer and you're looking to buy a property from a deceased estate, and therefore you're buying from what you've mentioned here, the executors, then there's no SDLT charge at all, no mind the 3% surcharge. So you do need to bear that in mind, because that could be a huge saving for you if you are going to be buying as a property developer and then flipping it on. There should not be a stamp duty and land tax charge buying properties from a deceased account. So hopefully that's given you some positive news from tonight's webinar, if anything. So please do a like if you think that's helped you out. I'm hoping it has. So that's there for you to be able to do that. So I'm just going to see if there's any other questions. I'm getting to a stage now, it's 7:45, so there's a lot of content that we've covered off tonight, so hopefully you found this useful. Make sure you press like and drop a comment in terms of what you found useful, and indeed, has this webinar been useful? Has this YouTube live been useful? Please don't be shy, drop a comment in there. If there are other questions that I've not answered, then please feel free to type those in now. I will try in the next 2 minutes, see if there's any questions coming in, and I will then answer those questions for you. I can't see anything now. I'm just going to go up to my web podcasting and see if there's any change on there. Let's have a look. So I can see Danny is on there. No questions from Danny either. Phil, I think I answered your question. Hopefully that's okay with you. Anyone else online that's got questions? Nope, I think we're good. So guys, Again, this is going to be a weekly event. I am going to be doing this from Mondays from 7 p.m. I am going to be stopping it short at 7:45. I've got some other things I need to do for medics. So if you're a medic investing in property, wow, you're going to be with me for an hour and a half. But thank you ever so much. I look forward to seeing you next week on Monday night, property investing and property tax Q&A at 7 p.m. next Monday, even though it's bank holiday. So I will see you on this channel. Thank you and have a great evening.